There are two main ways to make money: passive income and active income. Active income is when you trade your time for money, and your earnings are directly related to how much time you work. On the other hand, passive income is a way to make money that doesn't require you to do anything and isn't directly related to how many hours you've worked. Depending on the type of passive income, the opportunities and requirements are different. Still, they usually require an initial investment that pays off over time without the investor having to keep an eye on or change their holdings. This video will look at the 5 best ways to make passive income. But before we start our video, please subscribe to our channel and press the bell button as well. So let's start. Number 1. Dividend investing. Dividend investing is a way to get a steady stream of income from your investments by buying shares that pay dividends. It is one of the easiest ways for investors to make money without doing anything. Dividends are payments that a company gives to its shareholders. When an investor owns stocks that pay dividends, they get a cut of the profits of the company. Many investors want to be paid regularly for keeping their money in the company. This gives them a steady stream of income on top of any growth in their portfolio as the company's stocks or other holdings go up in price. But not every company gives a dividend. Usually, the board of directors decides if a dividend is good for their company based on a number of financial and economic factors. Dividends are usually given to shareholders in cash once a month, 3 times a year, or once a year. Dividend yields can be very different from one company to the next, and they can also change from one year to the next. So, investors who aren't sure which dividend-paying stocks to choose should stick to those that are called dividend aristocrats. This means that the company has been paying out big dividends for at least 25 years. How to choose the best stocks that pay dividends. When looking for good dividend-paying stocks, think about these things. Profitability over the long term is very important. Look for companies that are expected to make money and grow their earnings between 5 and 15% over the long term. Try to find companies that can generate healthy and steady cash flow, which is what is needed to pay dividends. A record of at least 5 years of solid dividend payments, which shows that dividends will continue to grow. Companies with too much debt that pay dividends should be avoided. Check a company's debt to equity ratio and stay away from companies with ratios above 2.00. In addition to analyzing the basics of a specific company, learn about the trends in the sector as a whole. Number 2. Cryptocurrency staking. Cryptocurrency staking can be a way for people who own digital assets to put them to work without selling or trading them. Staking Rewards says that as of April 2022, the total value of cryptocurrencies that have been staked has gone over $280 billion. Putting money into a cryptocurrency stake is like putting money into a high-yield savings account. When you put money into a savings account, the bank usually lends those funds to other people. In exchange, you get a share of the interest that the loan earns. In the same way, when you stake your digital assets, you lock up the coins to help run the blockchain network and keep it safe. In exchange, you can get rewards that are measured in percentage yields and are usually much higher than the interest rates banks offer. How things work. Staking is only possible with the proof of stake, POS. Consensus mechanism, which is how blockchains choose honest participants and check new blocks of data that are added to the network. Participants in the network, called validators or stakers, buy and lock away a certain number of tokens. This encourages good behavior in the network. If someone did something bad to the blockchain, the price of the native token would probably drop, and the person or people who did it would likely lose money. So, staking is a good way to stop fraud and mistakes from happening in this process. Ethereum, ETH, Cardano, ADA, Solana, SOL, Avalanche, AVAX, and Polkadot are some of the most well-known cryptocurrencies you can bet on, DOT. Also, most of the better-known cryptocurrency exchanges, such as Coinbase, Binance, and Kraken, have staking options. Returns expected. Staking Rewards has found that the average staking reward rate for the top 261 staked assets is more than 11% per year. But over time, rewards can change. Remember that fees also affect rewards because staking pools take fees out of rewards as payment for their work, which changes the percentage yields overall. So, the best way to get the most rewards is to choose a staking pool with low commission fees and a good history of validating many blocks. Number 3. Peer-to-peer investing. Peer-to-peer lending, which is also called social lending or crowd lending, is a way for people to get loans directly from other people, without going through a bank. At the moment, most peer-to-peer lending platforms are in the US and UK, but the trend is slowly making its way to Europe and some Asian countries. Peer-to-peer lending puts people with idle funds who want to lend them to people who need credit in direct contact with each other. This allows the lenders to get higher returns on their investments and the borrowers to get quick loans more easily and honestly. Lenders get the money they loan back every month in the form of AMIs, which are equal monthly investments that include both the principal and interest income. The peer-to-peer lending platform collects the AMIs from the borrower on behalf of the lender and puts them in the lender's escrow account, from which the lender can take money out or put it back into more loans. Another important point is that the risk of the lenders is spread out. This means that tens or hundreds of lenders with different risk profiles, demographics, and jobs invest in one loan. As a result, if the borrower goes bankrupt, the investors lose less money because the loss is spread out among them. Peer-to-peer lending platforms also use new products and ways of doing things to make it easier and take less time to build a portfolio. Zopo was the first peer-to-peer platform to open in the UK in 2005. Since then, Mintos, Neo Finance, Bondora, Peerberry, Estate Guru, Profitus, and Debitum Network have also opened. How things work. With smart investments, the money you make from peer-to-peer lending could turn into passive income. Reinvestment. AMIs can be taken out of an investor's account or put back into loans listed on the platform. First of all, data shows that lenders who reinvest make up to 10% more money than lenders who don't. Second, by turning on reinvestment, lenders make sure that their monthly earnings are automatically reinvested in the same products or plans they chose and continue to earn returns. Automated investment. Peer-to-peer lending platforms offer automated investment options that cut down on the time and work needed to build a portfolio. It's easy to add funds to be automatically invested and choose the different parameters that match your investment strategy with borrower profiles listed on the platform. Systematic income generation plans. The newest, best, and least time-consuming way to invest in peer-to-peer lending is for many investors to pool their money into a single portfolio. This makes building and managing the portfolio more efficient. The platform's algorithm will put the pooled money into a variety of loans and loan products that will offer high returns. Number 4. Investing in an index fund. An index fund is a type of mutual fund or exchange-traded fund, ETF, whose portfolio is designed to track the parts of a financial market index, like the S&P 500. You don't have to pick individual stocks to invest in. Instead, you can buy index funds to own a piece of many different companies. Index funds are also inexpensive, let you diversify your investments more, are usually low risk, and give you good returns over time. One of the most well-known indexes is the Standard & Poor's 500 Index, which follows 500 large, well-established U.S. companies in a wide range of industries. The Nasdaq Composite, the Dow Jones Industrial Average, and the Wilshire 5000 are some other choices. Vanguard 500 Index Fund, Admiral Shares, FIAX, Schwab S&P 500 Index Fund, SWPPX. Fidelity 500 Index Fund, FEX, Fidelity Zero Large Cap Index, FNOX, and Rowe Price Equity Index 500 Fund are all index funds with stock portfolios that are designed to track the S&P 500. PREIX. How to find the right index fund. When buying an index fund, it's important to keep a few things in mind. First, you should think about how much risk you are willing to take for the return and how risky the fund you are interested in might be. Then, make an investment plan that fits your goals and compare the costs of different funds that invest in the same sector. Number 5. Real estate investment trusts, REITs. REITs are companies that own, run, or finance income-generating real estate, such as apartments, storage facilities, warehouses, offices, malls, and hotels. They are a popular way to invest for many people who want to add more to their portfolios than just publicly traded stocks or mutual funds. Individual investors can get dividends from their real estate investments through REITs without having to buy, manage, or finance any properties themselves. Most REITs are also traded publicly, like stocks, on major stock exchanges. This makes them very liquid instruments unlike physical real estate investments. Getting started. Start by opening a brokerage account, where you can buy and sell REITs just like any other stock. If you don't want to trade individual REIT stocks, it can make a lot of sense to buy an exchange-traded fund, ETF, or a mutual fund that invests in a wide range of REITs. After vetting them, you get immediate diversification and less risk, and it takes less time to invest in them than to research individual REITs. Blue Rock Residential Growth REIT Incorporated BRG, Preferred Apartment Communities Incorporated, APTS, and Gladstone Land Corporation are 3 public REITs that have done well so far this year. Returns expected. One of the best types of assets out there is a real estate investment trust. Most investors use the FTSE Nareit Equity Right Index to measure how well the US real estate market is doing. From 2010 to 2020, the average return on the index was 9.5% per year. More recently, the average return on REITs over the next 3 years from November 2017 to November 2020 was 11.25%, which was well above the S&P 500 and the Russell 2000, which had returns of 9.07% and 6.45%, respectively. That's all we have for today. Subscribe to our channel for more money-making videos. Thanks for watching.